Hello, my name is Rakeshkumar Chauhan, Assistant Professor, Rai School of Management Studies. Today our topic is CAPM. CAPM means Capital Assets Pricing Model. It generally describes relationship between systematic risk and general perils of investing and expected return for an asset. Now, it is one type of financial model. It establishes one linear relationship between required rate of return on investment and method based on particular relationship, which is also measured with beta, with risk free rate, typically treasury bill rate, and another equity risk premium and the expected rate of return on market minus risk free return. Another capital asset pricing model evolved as a way to measure the systematic risk. So this is one model which is useful for measurement of systematic risk. Now it is widely used throughout for finance pricing for especially for risky securities. Another, generating expected return for asset given in the risk of those asset and cost of capital. Now here simple question will arise. Who is the founder of this model? The founder of this model was economist William Sharpe, Jack Tenor, John Linter and Jane Mossy in the early 1960s. It was around 1960s was there. It was found around that time period. So here formula is here. Now for calculation of this formula, here expected rate of return on asset given as risk and it is given as follow. Here expected rate of return for particular securities for investment is equal to RF plus beta, and here in bracket expected rate of return for market and rate of return for particular securities. Now where this formula denote expected rate of return on investment is equal to ERI. Another, RF means risk free rate. Another, BI means beta of investment. And another last point is ERM minus RF means market risk premium. Here from this model generally investor what they want. Investor expect to compensated for risk and time value of money. Generally we seen that on basis of risk, generally people think that on basis of risk what time value of money I will get. If generally we seen that longer time horizon is generally people think that it is more risky. So for longer time horizon people think that for long whether I am getting any more extra return on that, is it possible or not? If people are getting more return for longer time horizon, then it will be okay. If someone is investing any money for longer time horizon and they are not getting any extra premium, then investor will not be interested for investment. So this is basic fundamental behind this model. And this idea is also applicable for everywhere. We can see this same thing is for in fixed deposit. We seen that fixed deposit is available for let's say from 1 week to from various years. 1, 2, 3, 4, 7, 8 more than that. If we are investing for shorter time period, then rate of return will be lower. But if we are investing little bit longer time period, then rate of return will be higher. Another, now here main goal of CAPM is evaluate whether stock is fairly valued at its risk and time value of money are compared with its expected return. If we are investing in stock, let's say if we are giving more time, whether it is generating more return or not, the same psychology is applicable everywhere in stock also. If people are investing little bit longer time period, they will think that whether I am getting more in return on investment or not. So this is main formula of CAPM. Now another major concept is CAPM and beta. So in previous slide we discussed about CAPM. Now about beta. Now beta is of a potential investment is a measure of how much risk an investment will add to portfolio risk for to that look like market. If a stock is riskier than market, it will have beta greater than 1. So we seen that various times. How beta represent the particular value? Let's say beta value is more than 1. Means if market change is 1% and beta is more than 1, means stock is moving more than 1% in comparison of market. Let's say so many stocks are having high beta. If market will change 1%, they will change 1.5%. So this is called example of high beta. And same way, there is another point is low beta value. Same, that type of stocks are having beta value of little bit lower than 1%. If market is moving 1%, then stock will move less than 1%. So this is called beta. And another beta is also useful for volatility. It also one type of measurement of volatility. How stock is volatile. If stock is more volatile, beta will be higher. If stock will be lower volatility having, beta will be lower. Now, stock's beta is then multiplied with market risk premium, which is return expected from the market above the risk-free rate. Now here the same beta is here and we can expect risk factor for particular investment securities. So let's take one example here. For example, imagine an investor is contemplating a stock valued at rupees 100. Now at today and he is paying 3% extra also dividend also there. Now say that this stock has beta compared with market 1.3. So this means this stock is little bit more volatile in comparison of market portfolio. We can say let's say Nifty 50 index. If Nifty 50 will move 1%, this stock will move more than 1%, let's say 1.3%. So one can expect, now assume risk-free return is 3%. So here one can expect market rise will more than that. Here it can be 8% per year. Now we can see this thing here. The expected return on stock based on CAPM formula. How we got the answer 9.5? The answer is 3% plus 1.3%. So here 8 minus 1.3%, that is coming from that formula. So total answer will be 9.5%. Here expected return on CAPM formula is used for discount the expected dividend and capital appreciation of stock. We generally seen that there are two options are available for return on investment. One is dividend and another is capital appreciation. Generally in stock we seen that. Now if this discounted value of those future cash flow is equal to 100, then CAPM formula indicates stock is fairly valued relatively with lower risk. Now there are certain problems with CAPM and generally these problems are related with also assumption. Assumptions we will discuss in later part. The first one is here unrealistic assumption. There are certain assumptions which are not possible in real life. The first one is several assumptions behind the CAPM formula have been shown that we cannot see in reality. Let's check that assumption. Security market are very competitive and efficient. That is relevant information about the companies is quickly and universally distributed and absorbed. See, this is basic assumption here. But what we see in reality? So many times, so many people are having information just before the public. So so many times we listen this type of word, insider trading, insider information. What they are? Some people are having particular information just before some time, and based on that information they are trading on that. That is also called front running. So many people are involving in that, and that is totally illegal. We are not talking about that. Now another, these markets are dominated by rational, risk-averse investors who are seek to maximize satisfaction from return on their investment. So this is not possible every time. How can be a rational each and every time? And how can be people something like risk-averse? So this is not possible at all in each and every situation. Now as a result, what will happen? It's not entirely clear whether CAPM work or not. If these assumptions are not possible in real life, then how it will applicable in real life? So these are the major problem with this model. Now another, we also found some differences in beta over a lengthy period did not explain the performance of different stock. Okay, we seen that in long run beta also will change with the change of time. So it is not possible to measure beta on particular time period. Beta will change according to the time. Now there is a linear relationship between beta and individual stock return also break down over a shorter period of time. Sometime it is possible. We seen that in so many stock beta is applicable for particular time period, but let's say for shorter time period sometime beta is not applicable. According to beta stock will not move. That is possible. Now these are the some findings which are seem suggest the CAPM model may be wrong. So these are the assumptions. We can say that sometime it is not to apply this model. Now including beta in the formula assume the risk can be measured by a stock price volatility. However, price movement in both directions are not equally risky. So again, let's say beta also indicate volatility. But as an investor, let's say someone having long position, they bought already some shares. So at that time, on long side, beta will be good one. But same, on downside or short side, beta cannot be good one. So this is possible for any firm. Now, however, price movement in both direction are not equally risky. The look back period to determine stock volatility is not standard because stock return are not normally distributed. We seen that so many times returns are not 100% sure short, and each and every year they are not equal. So we cannot fit one criteria for all the time period. Another, CAPM model also assume the risk-free rate will remain constant over the discounting period. So this is also not possible in each and every situation. With change of time, we seen that so many time period for let's say rate of return will be different, discount rate will be different, risk-free rate will be different. So various types of rates will also change with the change of time. Now another major point is estimating the risk premium. So this is one important concept for CAPM. Here we are estimating the risk premium because in concept of CAPM risk premium is also important. The market portfolio used to find market risk premium is only a theoretical value. It is not asset that can be purchased or invested in the alternative of the stock. But in reality, various types of alternatives are available and we can invest in that. Now, most of the time investor will use major stock index likely Nifty 50 substitute the market, which is imperfect comparison. Nowadays, we can see this type of scenario is there. Before some time, people are not investing in index. But nowadays so many people are investing in index. In case of index, people are not investing in just one stock, but they are investing in all the stocks which are in that index. So this is not fair comparison. Now the most serious critique of the CAPM is the assumption that future cash flow can be estimated for the discounted process. In case of company, we cannot predict each and every time future cash flow. It is depend on number of factors. If an investor could estimate the future return of stock at high level of accuracy, then the CAPM would not be necessary. So let's say someone is having all the information about the company, then this model will be not useful. Now, another CAPM and efficient frontier. Using CAPM model build portfolio is supposed to help investor to manage their risk. Here by use of CAPM we can manage the risk. Whether I am getting more return in comparison of taking less or more return or not. So this is possible here. We can measure that portion whether I am getting more return or not. Another, if an investor were able to use CAPM perfectly optimize the portfolio return relative to risk, it would exist on curve called efficient frontier as shown in the following graph. So let's see that graph. So here risk-free return is given. Generally we seen that in fixed deposit and that type of debt instrument we can see that type of risk-free return. It is generally flat. We can expect from the market whether I am investing any amount, I will get return on that security or that instrument without any risk. So this is risk-free percentage or return. And there is a one ideal market portfolio which is based on market, which can generate ideal rate of return. And there are efficient frontier, means there are various types of inferior portfolios and individual assets are there, and they are generating various types of return and various types of risk. It is also denoted that if we are involved in more risk, then there should be more return also. One can use also for this purpose, for various purpose, that one can get, if one is having more risk, then one can also think about the more return also. Now, the graph shows that greater expected return on y-axis require greater expected risk. We can see that this is also related to market also. In market we can see that there are number of risk related factors and number of return related factor. So one can assume that on basis of risk how much return I am getting. If I am taking more risk, whether I am getting more return or not. So this is called simple relationship of risk and return. Now CML means capital market line. Now the efficient frontier may be difficult to define, but they illustrate important concept for investor. There is a trade-off between increased return and increased risk. Another, because it is not possible to perfectly build a portfolio that fits for particular market line. So for all investors this is not possible to measure risk and return, and they are generally we cannot see this type of investor who can beat each and every time this type of risk and return. Now in this thing we can see that investor should always think about return and risk. So there is another chart. You can see another portfolio which constructed to fit along with efficient market frontier. The portfolio A is expected to return 8% per year, has a 10% standard deviation or risk level. Now portfolio B is expected return is 10% per year, but standard deviation is 16%. So here standard deviation is more. Standard deviation is also one type of measure which for measurement of deviation or variation. The risk of portfolio B rose faster than expected return. Let's see that. So here we can see if one portfolio A is having little bit more risk, 10%, and same here return is 8. Now, but we can see for B, it is expected risk is 16%, but here we can expect 10% return. So here there are in capital market line, we can see that one can generate more return and use of risk also. One can generate more return on basis of the risk also. Now, thank you all of you. This is for today.